Most option traders think the cheaper contract is a smarter contract because it gives you more leverage. Across 67 years of market history, that logic gave you lower returns and worse drawdowns. The further out of the money you go, the worse the results get. And the best answer wasn't one strike, it was a narrow zone. Today, I'm going to show you where that zone is, why it works, what it looks like at every allocation, and how to use it at any portfolio size. In the last video, I tested how much of your portfolio should go into LEAPS. I showed you every allocation from 90-10 to 50-50 and landed on 80-20 for my personal accounts. Today, we answered the second question, where the strike should go. Same test, same 67 years, same $100,000. If you haven't watched that one, I'll link it in the description. Before the data, let me make sure everyone understands the math. If SPY is at $680, a 10% in the money call has a $612 strike. $680 times 0.9, the strike is below SPY, so the contract already has $68 of real value baked in. That's intrinsic value. It moves dollar for dollar with SPY. A 10% out of the money call has a $748 strike. $680 times 1.1. SPY has to rally to $748 before the contract has any real value. Everything you paid is extrinsic value. Time and volatility. When the market drops, extrinsic value collapses. Intrinsic value doesn't. That one concept explains almost everything I'm about to show you. Let's start with what happens when you go out of the money. At the money, 11.77% CAGR, 57 max drawdown. 20% out of the money, 11.04%, 65% max drawdown. Less return, more risk. An out of the money contract is entirely extrinsic value. When the market drops, extrinsic value collapses. And a 30% sell-off, a 20% out of the money contract loses almost everything because there was nothing real underneath. But crashes aren't the only problem. Out of the money contracts bleed in the most common kind of up year. SPY up 5 to 10%, the market didn't move enough to overcome the time decay. Those mild years happen far more often than monster years, and that's why out of the money loses the long game. Now, the other direction. What happens when you go in the money and why? When you buy a 10% in the money contract, you have a 10% cushion of intrinsic value. If SPY drops 5%, the contract still has real value underneath it. It's not pure time value getting crushed. But if SPY drops 15%, that cushion is gone. The contract is now out of the money and fully exposed. A 20% in the money contract gives you a bigger cushion. SPY has to drop 20% before the intrinsic value is completely gone. That's why deeper in the money contracts held up better during the crashes. The cushion lasted longer through the decline. It's not that they can't lose money, it's that they have more room to absorb the hit before the protection disappears. So why not go as deep as possible? Because you lose acceleration. At 10% in the money, the delta is about 70. As SPY rises, delta increases towards 80 or 90. The option accelerates. That acceleration is the reason the overlay adds value over just holding stock. At 30% of the money, the delta is typically 80 or 90, depending on rate environment. There's very little room to accelerate. The option mostly just tracks SPY. You're paying more for a little extra protection while getting less of the upside that makes the overlay work. The sweet spot is deep enough for intrinsic values to protect you in a crash, but close enough to the money to accelerate. Now the data. I'm going to show you every allocation and every strike so you can find the combination that fits you. There's a lot of data coming at you here, so feel free to pause on any slide if you need to. I'm going to hit the highlights, but the full numbers are up on the screen for you. Start conservative, 90-10. At 90-10, the gap between the best strike and at the money is 0.03%. The strike barely matters. Only 10% of your money is in LEAPS. If you choose 90-10, pick any strike from at the money to 20% of the money and move on. Just don't get out of the money. Now, 80-20. 10% in the money peaks at 11.89%. At the money is 11.77%, a 0.12% gap. But look at drawdowns. At the money, 57.4%. 10% in the money, 54%. 20% in the money, 51.8%. For context, SPY alone dropped 32.5% in 2008. The overlay adds about 10 to 12 points of additional drawdown at 80-20 depending on the strike. That's the cost of leverage. Win rate goes from 66% at the money to about 70% at 20% in the money. Now, 70-30. 70-30 peaks at 12.35% with 15% in the money. Higher than 80-20. But the portfolio still loses near half its value in the worst year. At the money at 70/30 drops to a 68% max drawdown. The gap between in the money and at the money widens to 0.28%. The more you allocate to LEAPS, the more the strike matters. Now, I showed you in the last video that 60/40 and 50/50 start breaking down. 60/40 at its best strike returns 12.69%. That's almost a full percent more per year than 80/20. Over 30 years, that compounds into real money, but the max drawdown is 67.5%. Let me put that into dollar terms. If your portfolio hits $500,000, a 67.5% drawdown takes you to $162,500. At 80/20 with 10% of the money, the same crash takes you to $230,000. That's $67,500 more paying for that extra percent of annual return. And it doesn't happen in one day. It grinds down over 2 or 3 years. You log in every month and it's lower. Every quarter it's worse. You start questioning everything. And the whole time you know that if you'd just gone 80/20, you'd be sitting at $230,000 instead of $162,000. That's the mental math that breaks people. And for those thinking a low carry rate environment makes 60/40 safe, carry affects the annual edge, not the crash damage. The dot-com crash started in a low carry environment. 2008 happened at a moderate carry environment. Crashes don't wait for high rates. Now 50/50 at the money, 84% max drawdown. On a $500,000 portfolio, that takes you to $80,000. And this, once again, wasn't a one-month flash crash. This was years of consecutive losses during the dot-com crash, a partial recovery, and then 2008 hitting on top of it. Can you say it won't happen again? No. 2 back-to-back bear markets is not a once-in-history event. It happened in the data, which means it can happen to you. And 20% out of the money at 50/50 actually loses to SPY. You took maximum risk and got less than the index. The CAGR looks great on the spreadsheet. The drawdown is what you have to live through. Now, let me put it all together. What do these combinations actually look like in the worst periods? SPY column on the left gives you context. SPY alone dropped 32.5% in 2008 and lost 8.9% over the entire lost decade. Every overlay combination lost more. That's the cost of leverage. The question is, how much more? 90/10 at the money adds about 6 points of worst year pain versus SPY alone. 80/20 at the money adds about 11 points. But move to 10% in the money at 80/20 and the extra pain drops to about 10 points, while the long-term return actually goes up. Move to 20% in the money and the extra pain drops to about 9 points. 80/20 at 10% in the money stayed positive during the stagflation decade, while the at the money went negative. That's the intrinsic value cushion working exactly as expected. The allocation is the gas pedal. The strike is the seatbelt. You need both set correctly or the system doesn't work. Now in the last video, I broke down the overlay decade by decade. Let me do the same thing here with my recommended combination, 80/20 at 10% in the money. 5 of 7 decades, the overlay added value. 2 decades, it hurt. Same pattern I showed you at the money in the last video, but notice the stagflation decade. At the money went negative at 0.21% per year. 10% of the money stayed positive at 0.44% per year. The deeper strike kept the portfolio out of the red during the worst decade for the strategy. The 1998 to 2007 decade still hurt. 2 back-to-back crashes will drag any LEAPS overlay, no matter where you place the strike. But the damage was less, negative 1.2% per year versus negative 1.9% at the money. Every decade, the deeper strike either added more edge or reduced more pain. So here's the answer, and it's not a single number, it's a range. At every allocation, the productive zone runs from at the money to about 20% in the money. Inside of that zone, you're choosing what you want to protect against. Deeper in the money gives you crash protection and a higher win rate. Closer to at the money gives you more upside acceleration of bull markets. You don't know which environment is coming next, so you position based on what drawdown you're willing to sit through. If you force me to pick one number at 80/20, the data says to me 10% in the money. But the real lesson is that the market gives you a productive zone, and inside that zone, the trade-off is not return versus failure, it's return versus smoother survival. Across every major market regime in the data set, the zone held up. Out of the money strikes consistently gave you less margin for error. The allocation determines how much risk you take, and the strike determines how you take it. Now, how does this work with real money? If your portfolio is $200,000 and SPY is at $680, your LEAPS budget is $40,000. The $680 at-the-money call costs about $11,500. The $612 strike, 10% in the money, costs about $16,000. You can buy two 10% in the money contracts at $32,000 and one at the money at $11,500, total of $43,500. Now that's roughly 22% of your portfolio, which is close enough. You're spread across the zone. This is not a precision game. Pick one strike in the zone and stay there if you want simplicity. Mixing it is just a tool when contract sizing makes the math awkward. The strike zone from at the money to 20% in the money is where the best risk-adjusted returns live. If your account is large enough to buy a contract in that zone, that's where you want to be. But if your account is smaller, say $30,000 or $35,000, and you can't afford an at-the-money contract, a slightly out-of-the-money contract still has a meaningful edge over SPY. At 10% out of the money, the data shows almost a full percent of annual edge. The win rate is lower and the drawdowns are bigger, but the edge is real. Here's the question you need to ask yourself. It's not whether you can afford the contract, it's whether you can afford to replace it. If you're saving $500 a month and you buy a $7,000 out-of-the-money contract and the market drops and that contract goes to zero, can you keep saving and buy a fresh one next January? If the answer is yes, you can participate because that fresh contract you buy after a crash at the lower price is where the recovery happens. We showed that in the last video. After 2008, the 2009 contract returned 79%. If you're saving $1,000 a month, that's $12,000 a year. That's an at-the-money contract restored in about a year through contributions alone. And as your account grows, you move into the zone. The goal is to get in the game as early as you can, contribute consistently, and move deeper into the zone as your portfolio lets you. 100% SPY is not a bad starting point. 10.5% over 67 years is better than most professional fund managers. But if you have a savings rate to absorb a loss and replace the contract, the data says the overlay adds value even at slightly out of the money strikes. And one more thing, you don't need to buy SPY for the 80% side. Any S&P 500 index fund works. VOO, SPYM, or any other S&P 500 index fund. The LEAPS contracts are on SPY, but your index allocations can be anything that tracks the same index. For smaller accounts, a lower price fund like SPYM keeps more cash available for the LEAPS side. For my retirement accounts, I'm running 80-20 at 10% in the money. That gives me the highest overall return at 80-20, a 66% win rate, and a worst year of negative 43%. SPY alone dropped 32.5% in the same year, so the overlay added about 10 points of extra pain in exchange for 1.39% per year over 67 years. I choose 80-20 over 70-30 because the extra 0.5% per year isn't worth the jump from a 54% drawdown to a 64% drawdown. And I choose 10% in the money over at the money because it has a slightly better return with a lower drawdown and it stayed positive during the stagflation decade while at the money went negative. Where you land depends on your situation. If you want the smoothest ride, 90-10 at any strike in the zone. If you want more return and can handle a 50% drawdown, then 70-30 with a deeper in-the-money strike. The data is here. You pick the combination that lets you sleep at night. Between this video and the last one, you now have the core framework. How much goes into LEAPS, where the strike goes, and how to fit it in your portfolio size. Pick your allocation, pick your spot in the zone, one trade per year, buy in January, sell 12 months later, repeat. Historical data across 67 years shows these combinations improve long-term returns without turning this into a full-time option strategy. In a future video, I'll show you exactly how I'm running this in my real retirement accounts. Real balances, real positions, and real decisions. That's where the back test meets the real money. The point is not to predict better, it's to build a structure you can actually survive. What allocation and what strike would you run? Drop it in the comments. If this helped make the system clear, hit the like button. If you want rules-based investing content without the hype, please subscribe. Stay disciplined, stay patient, and I'll see you on the next flight.